Something just snapped in the silver market, and most people still don't realize what they're looking at. The charts moved, headlines flickered, commentators argued, but the real shift didn't happen on the surface. It happened underneath, quietly, invisibly, in the part of the market most people never see. This wasn't just volatility. This wasn't just another spike or dip. This was a structural break. And once a market crosses that line, there is no clean way back. Because here's the truth no one wants to say out loud. Markets don't collapse when prices fall. They collapse when trust disappears. And right now, trust in the paper, silver market is being tested in a way it hasn't been in decades. What you're watching isn't a panic yet. It's something far more dangerous. It's insiders stepping away while everything still looks normal to the outside world. No alarms, no emergency headlines, just quiet exits. And history tells us that when exits start happening quietly, it's because the people closest to the system know something the rest don't. They exited first. To understand why this matters, you have to forget the price for a moment. Forget whether silver is up or down today. Forget predictions about $50 or $100. Those numbers don't matter if the system setting the price no longer works the way I'm supposed to. Because a price is only meaningful when the mechanism behind it is stable. And stability is exactly what just broke. The paper silver market is built on leverage, extreme leverage. For every ounce of physical silver that actually exists, there are dozens, sometimes hundreds of paper claims tied to it. Futures contracts, options, ETFs, derivatives layered on top of derivatives. For years, this worked because not everyone asked for delivery at the same time. The system depended on confidence, rollover behavior, and the assumption that settlement would always be possible. But assumptions are fragile things. The moment too many participants stop treating paper exposure as interchangeable with real metal, the entire structure starts to strain. And strain shows up in strange ways. Liquidity thins when it shouldn't. Spreads widen without warning. Price moves don't match volume. Settlement language becomes more flexible. Rules get adjusted quietly. All of these are early warning signs. And right now we're seeing too many of them at once. This is where insiders start paying attention. Because insiders don't need a collapse to act. They only need probability to shift. The moment risk outweighs reward, they reduce exposure. They don't announce it. They don't make dramatic moves. They just stop leaning on a system that no longer feels solid under their feet. That's what exited first really means. It doesn't mean dumping everything in one day. It means gradually stepping away from dependence on a fragile structure before it becomes obvious to everyone else. It means moving risk off balance sheets while liquidity still exists. It means positioning for disorder, not upside. And that's exactly what's happening now. Look closely at how the market is behaving. When demand appears, price doesn't respond the way it used to. When selling pressure hits, price moves faster than expected. That tells you something critical. Liquidity is conditional. It's there when markets are calm and gone the moment stress appears. Conditional liquidity is not real liquidity. It's confidence masquerading as depth. This is how paper markets fail, not with explosions, but with hesitation. And hesitation is deadly in leveraged systems. The reason most people miss this is because they retrain to look for confirmation in price action. They're waiting for a big red candle, a dramatic crash, a clear headline that says, the system is broken. But by the time that happens, the advantage is already gone. The people who understand the structure don't wait for proof. They act on signals. Think back to 2008. Banks didn't fail the day Lehman collapsed. They failed weeks and months earlier when trust evaporated behind closed doors. Interbank lending froze before the public understood why. Balance sheets were quietly adjusted long before panic reached the streets. The collapse was loud, but the exit was silent. Silver is following that same script. Another thing almost no one talks about is settlement risk. Paper markets function because participants believe contracts will be honored as written, but when stress rises, flexibility creeps in. Cash settlement becomes more acceptable, delays become normalized, exceptions become precedent. And once that happens, the nature of the contract changes. At that point, you're no longer trading silver. You're trading confidence in a promise. And confidence is the first thing insiders abandon when systems weaken. This is why the phrase point of no return matters. Because structural damage isn't fixed by price recovery. Once trust erodes, it doesn't magically come back because the chart looks better. The memory of fragility remains. Participants change behavior permanently. They demand higher premiums. They shorten time horizons. They avoid exposure they once considered safe. This is how markets become unstable long-term. Silver isn't just another asset. It sits at the intersection of money, industry, and energy. It's used in electronics, solar panels, medical equipment, and defense applications. When the pricing mechanism for something that essential becomes unreliable, the consequences extend far beyond traders. Manufacturers don't hedge production based on theories. They hedge based on delivery certainty. When that certainty fades, costs rise, supply chains strain, projects get delayed. And those delays ripple outward into the real economy. This is why governments eventually care, not because of price speculation, but because strategic materials can't be allowed to spiral uncontrollably. When markets stop self-regulating, oversight increases, controls tighten, transparency decreases, and every intervention, no matter how well-intentioned, further distorts behavior. This creates a feedback loop. Participants stop trusting the market. Regulators respond with controls. Controls reduce trust even more. Liquidity pulls back further. And suddenly, the system everyone relied on becomes brittle. This is where we are now, and it explains why the smartest players aren't asking how high silver can go. They're asking how functional the market will remain under stress. They're asking whether paper exposure still serves its purpose. They're re-asking what happens if too many people ask the same uncomfortable questions at the same time. Because when that happens, exits stop working. Crowded exits are the most dangerous part of any market. Everyone assumes they can leave when they want, but exits only work when few people use them. The moment everyone tries, doors jam, prices gap, settlement rules bend, and losses compound in ways no model predicted. That's why insiders exit early. They don't need certainty. They need margin of safety. And margin of safety is disappearing from the paper silver market. You can see it in how narratives are shifting. For years, the conversation was about manipulation, suppression, and long-term upside. Now the conversation is about delivery, availability, and trust. That shift alone tells you something fundamental has changed. When people stop debating price and start debating structure, the game is no longer the same. Another subtle sign is how emotion is changing. Early bull markets are driven by excitement. Late-stage structural breaks are driven by anxiety disguised as confidence. People become louder, opinions harden, debate intensifies. That's not strength. That's stress leaking through language. Markets communicate through behavior before they communicate through numbers. And right now, the behavior is defensive. This is also why predictions are becoming more extreme. When systems destabilize, people gravitate towards certainty, even if it's false. Some promise massive upside. Others predict total collapse. Both miss the real issue. The issue isn't where price goes next week. It's whether the framework supporting the price can survive sustained pressure. If it can't, price becomes irrelevant. This is uncomfortable to hear because it removes simple answers. There's no easy trade, no guaranteed outcome, just increasing fragility and narrowing options. That's not a message most people want. But it's the message history repeats over and over. The pattern is always the same. First, insiders quietly reduce exposure. Then liquidity thins. Then volatility increases. Then rules change. And finally, the public notices, long after the advantage is gone. They exited first. And the reason they always do is simple. Systems reward those who act before narratives change. Once narratives shift, it's already too late. This doesn't mean disaster is imminent tomorrow. Structural breaks don't work on schedules. They work on stress accumulation. Pressure builds, releases slightly, builds again. Each cycle leaves the system weaker than before. And eventually, a small shock causes disproportionate damage. That's what snapped really means. Not that everything collapsed instantly, but that the elastic limit was exceeded. The system no longer returns to its original shape after stress. It deforms permanently. You can already see that deformation in how market participants behave. Longer settlement times are tolerated, higher premiums are normalized, alternative sourcing becomes attractive. None of this would happen in a healthy market. This is why the smartest move isn't prediction, it's awareness. Understanding how markets break gives you an advantage most people never have. Not because you can time the collapse, but because you don't rely on systems that require perfection to survive. You stop assuming stability is guaranteed. You stop trusting appearances. You read signals instead of stories. That's what this channel is about. Not fear, not hype, clarity. Because clarity is what allows you to move before noise overwhelms reason. The paper-silver market may continue functioning for a while, or stress may accelerate faster than expected. No one knows the exact timeline. But what's clear is that something fundamental has changed. The behavior has shifted. The assumptions are breaking down. And once that happens, going back is nearly impossible. This is the silent phase, the phase most people ignore. And it's always the most important one. So watch what insiders do, not what commentators say. Watch liquidity, not price. Watch trust, not headlines. Because when trust finally breaks publicly, exits will already be closed. They exited first. And now the only question that matters is whether you understand why. This isn't about silver alone. It's about recognizing structural stress wherever it appears. Because the same dynamics repeat across markets, systems, and institutions. Those who learn the pattern survive transitions. Those who don't are forced to react. This is the silent collapse. Not loud, not dramatic, but relentless. Stay aware. Stay rational. And most importantly, don't wait for permission to understand what's already happening. Because by the time everyone agrees, it's over.